I'm having a good morning, so I hope you guys are too. And just a moment here, I want to check something out. There we go. So, good morning, Helen. Good morning, Brenda. Kevin, good afternoon. Welcome, everybody. And yeah, so, we're pretty busy here, obviously, at Wealth Builders HQ. Got a lot of stuff going on. This is recorded, and it'll also be available on our YouTube page. So, you can go ahead and check out the YouTube page for Wealth Builders HQ, find us there. This and other videos will be available. I'm pretty busy with E-mini Think Tank. 3 days a week, I do a live workshop on futures trading. And when it comes to options, I actually am busy with what's called the SPX Cash Flow Secrets, which is a program that I run. Let me see, where's there it is, members page. So I'll talk a little bit more about that. We're talking today about some options opportunities, generating income using options, basically. So right here, to go into SPX Cash Flow Secrets, I teach people how to utilize a strategy I've been using for many, many years with a lot of success in options. And actually, while I'm thinking about it, let me see if I have that up. SPX Cash Flow. No, it's the wrong one. I'll bring up last month anyway, but I was trying to find the tracking sheet that I have for the annual, just to give you an idea of the trading. You want to trade smart. You don't have to trade hard or long. Time is not necessarily the factor or the winning secret to being successful in the markets. It's being consistent and doing things the right way. So there it is. That's what I was looking for. I get to brag a little bit. Basically, I tracked all my win percentages, and these are all the trade ideas that I put out in the SPX Cash Flow program. We started in 2021 in November. And basically, every month did pretty well. The average for 2021 was almost 90% win rate, 2022 to 83.97%, and then 86.85% so far for this year. And that's the average number of winners and losers per month. So, taking a look at this year, for instance, like I said, we want to build consistency, and being right is always a good thing. And I was right 86% of the time on average. Last month was kind of a standout month, if you will, by the win rate. I didn't make as much as I would have possibly on other months, but again, did well. And that's the key thing, is building consistency. Our average win was $42, which is a little lower than some, but we had a lot of wins. So only had one loss last month. I track everything I do. And like I said, generating income, this is using options. The average entry time, this is from November. So last month we just finished, and then I went on vacation. But the average entry time and the average or the overall market close, you can see I was in this trades for less than 2 hours on average. So building consistent income is definitely possible using options. You could do it every day, but you don't have to. There's opportunities to generate income longer term as well. So there's a lot of different things that we can do with these options. As I said, they're very, very flexible. And, that's what I want to talk about a little bit today. So like I said, this month was pretty good. 19 wins, only one loss. That's what I like to see. Consistency. That's what we want to build in these markets. So that being said, let me see, where am I going to go here? I want to go. We talked about that. Again, I just want to show you a lot of things. If you want to stay in touch with us, there's plenty of ways to do that. Easiest way is just to email us. If you have any questions about anything here today and you want to learn more, if you're one of my students, obviously you have the messaging there, but you can also email us at support@wealthbuildershq.com. So basically, when it comes to options, we want to keep things as simple as possible. And options are not that difficult, honestly. People get confused, and they hear options and they get scared because they see things like this. They go to an option chain, for instance. If I go to my trade page here, let's see what it brings up. SPX. And then they jump in and look at something like this. As a matter of fact, I got an email earlier today from a student who said, yeah, I don't know about those whole options because, there's so much to worry about, the Greeks, and they're complicated. And, they're really not. If they're explained properly, they're not very complicated. There's options are just contracts, basically. And there's two things that you can do with those contracts. You can either buy them or sell them. That's it. They get confused with options are all you trade. That's great. Yeah. Analyze tab makes it nice. Absolutely. There's a lot of neat little tools, depending on which platform you're trading on, obviously, that you can use to make your trading life easier. But yeah, there's delta, gamma, theta, vega. There's a lot of different types of Greeks. Well, they're actually only 5. They're just risk parameters. But if we try to simplify everything, break it down to the most simple terms, bring up this slide, there are 2 types of options: calls and puts. That's it. And actually, even easier if you think about it this way. Let me bring up, actually, I'll go over here. And I don't want to mess up that page, so we'll mess this one up. When it comes to options, as an example, we have calls, which are basically coupons. That's all they are. They're coupons. And we have these coupons. First of all, options are available on a multitude of different securities. Options are a derivative. That means they derive their value from something else. There we go. Maybe, yeah, they're derivatives. So they derive their value from another security. And that other security could be, let me shrink that down a little bit so we can see better. There we go. It could be a stock. Most people trade options on stocks. There could be options on futures, options on indexes, and depending on where you are, there's actually options on Forex as well. But that is not as heavily regulated, and it can be a little bit dangerous, so be careful with those. But there are definitely options on different things. And basically, an option is nothing more than a contract. And with a contract, every contract has to have 5 things. It doesn't matter if you're talking about futures contracts, options contracts, contracts for a football player and the team. It doesn't matter. You have to have these 5 things. You have to have a buyer and obviously a seller. You have to have something being traded. You have to have a price, or the cost of whatever's being traded. And finally, you also have to have an expiration date. Without those 5 things, you cannot have a contract, really. If you want to buy a house, you write up a contract and you submit it to the seller of that house saying you'd like to buy it for a certain price. The house is what's being traded for money, and there's an expiration of that escrow. So you got to close before the expiration. Oh, yeah, ETFs as well. Thank you for that, Brenda. Yeah, I kind of include that with stocks. So stocks, it could also be ETFs. You're right. I didn't include that, but sometimes in my brain, I think of that, stocks, ETFs are so similar. But you're right. Absolutely. Anyway, call options, like I said, are coupons. And basically, a coupon that gives you the right to buy something. I should say it gives the holder of the coupon. The holder is also known as the buyer. The right to buy something. Well, you can get the right to buy the stock. You get the right to buy the future, the ETF. You can't really buy the index, okay? Or, well, you can get the right to buy a futures contract. Basically, if something cannot be delivered, such as an index, what will happen is those options will be cash settled, meaning loser pays the winner at the end. But otherwise, if you buy a call option, then you get the right to buy stock, or you get the right to buy the ETF, or the right to buy futures at or before the expiration of that contract. So call options are coupons. It gives the holder or buyer the right to buy something. At the same time, with that coupon, the seller, or in this case, the writer, because they are creating a new contract, they're writing a contract when they sell, basically the seller assumes an obligation. to deliver whatever it is being traded. So buyers get rights, sellers get assume obligations. There's a big difference there. What was I doing here? Right. Whoops, that's not what I wanted. Do bold on just one of these? No, I guess not. Okay, anyway. So puts, a little different, but not too bad. Put options, I'll just say put options, are basically nothing more than insurance. That's all it is. Put options are insurance. Insurance gives the buyer the right to sell something. At a higher price. There we go. So I'll explain this and also clean it up, actually. Do this. Voila. Okay. So put options are insurance. Basically, let's say a car, you buy an insurance policy on your car. You basically bought a put on your car. If the value of your car goes up, that insurance policy is useless, right? Because you wouldn't want to sell at a lower price. But if your car is wrecked, you crash your car, something happens to it, the value of that car might have dropped to zero. It's not drivable anymore. It's a hunk of metal, but you still have the right to sell that car to the insurance company for the value it was before it crashed. Okay, so that's a put option. In this case, we could buy an insurance policy on a stock or an ETF or a future. And if the value of that security drops, you still get to sell it at the value it was before it crashed. And obviously, if the buyer gets a right, the seller also assumes an obligation here at the same time. So in this case, the seller or writer they get the right to, or I'm sorry, they assume the obligation to buy what we call the underlying security. And the underlying is whatever you're trading or whatever the derivative is on, the stock, the future, whatever it may be. So that's it. We just have two options, calls and puts. Keep it simple. And not only that, but there's only two things you can do with them. You can either buy options or sell options. So there's only four possible positions, if you will, basic positions that you can do in options. So there's nothing you should really be scared of. As a matter of fact, you want to keep options trading as simple as possible. Now, simple doesn't mean easy. Okay. Simple is simple. There's simple steps you need to follow, but there may be quite a few steps. Actually, when I trade options, there's really only three major steps. So I joke and I say it's like Leonard Skinner, give me 3 steps, give me 3 steps towards the door. So here are 3 steps for options trading. Number 1, what direction is the underlying security going? Are we going up? Oops, that's not what I meant to do. I hit the wrong keystroke there. Are we going up, down, or sideways? Okay, so that's number 1. Which direction is that underlying security going to be headed? Are we going up? Are we going down? Are we going sideways? Do we even know? I mean, we should. If we're going to trade something, we should have an idea. There we go. Fix that. Number 2. Once we figure that out, we need to know, and this is very important, are options cheap or expensive? Obviously, if options are cheap, we buy or do what's called a debit, meaning we're paying for options. But if they're expensive, you sell things that are expensive. So we're going to do credit or debit, depending on which direction based on how expensive or cheap the options themselves are. And then finally, once we figure that out, we need to see what is the correct strategy. Find and implement it. That's it. That's options trading, if you want to keep it as simple as possible. So, getting into the options trading, as I said, there's only two types of options, calls and puts. There's only two things that we can do: buy them or sell them. And even if you're doing what we call multi-leg options trading, basically there's two types of options trading. If you really want to kind of simplify it, actually, we'll do a new one here. You've got what's called single leg. And it's basically just one option. Now, when I say one option, you could do multiple options, like you can buy 5 calls or 5 puts, but you're basically only doing one type of option per position. So it's basically buy a call or calls, or buy a put, again, or multiple puts, or sell a call or sell a put. That's it. But we're doing one option type to get into that position. Well, the other type is what's called multi-leg. And that's where basically you use more than one type of option. Okay. But when it comes to that multi-leg, let's see, multi-leg is when you have to account for liquidity, bid-ask spread, being tied up. Yeah, sure. There's a lot more to it, of course. Yeah. So when it comes to multi-leg options, there's actually 2 pieces to it, regardless of how many options you end up doing. I mean, you could do 3, 4, 5, 10, it doesn't matter. There's a lot of different things you could do with multi-leg, but you have what is called the anchor leg. And the anchor leg is basically, it drives the position. It is the profit center. It's how you make your money. If you think the markets are going up, your anchor leg would be a bullish option. If you think markets are going down, then your anchor leg would be a bearish option. So that's the profit center. The next part of that, and again, this is under the multi-leg, but the next part of that is the offset leg, or legs. There can be more than one. And basically, these are used to manage risk and change the Greek effect. I mentioned Greeks are risk management for options. It's how to measure what is going to affect the pricing of the options. So when we use these offset legs, you'll see we're using the kind of offset undesirable characteristics of an option position. That's really what it comes down to. So, as I said, you want to take a picture of this, go for it. I don't mind. Do a screenshot. Your own notes. Speaking of, actually, I'll do that myself. All right, save that for later. Okay, so again, going back to my slide here for a moment. Simple tools, calls and puts. Like I said, we can buy them or sell them. So buying a call option is a bullish strategy. So if that were our anchor leg and we were bullish in the markets, we might buy a call. But that's not the only thing we can do. Okay. There's other things we can do for a bullish strategy. Again, we're on step one. Do we think the market's going up, down, or sideways? These are some of the things that we can do to take advantage of that. So everything in the markets and options markets is equal and opposite. So if buying a call is bullish, selling a call is going to be bearish. Simple, right? Now, you notice we have green arrow and red arrow both under a call. So we can use calls for bullish strategies or bearish strategies. If you buy a put, you buy an insurance policy when you're worried about prices dropping. So that is a bearish strategy. So you notice if I'm bearish now, I have two possibilities of what I can do for my anchor leg or even single leg. I could either buy calls or I could sell puts. That's it. I'm a handy dandy back scratcher. So buying a put, everything's equal and opposite. Selling a put is therefore going to be bullish. Okay. So again, if you are bullish in the markets, you can either buy a call or sell a put. Your choice. You can do either one. Yeah, let me switch over again and give you those notes. Actually, this is probably the better picture right there, if you want. So you do a screenshot of that if you like, before we move on. All right. So, as I mentioned, we're talking about trying to generate income for ourselves. And when it comes to generating income, we want high probability. That's what we really need to have when it comes to our trading. It would be great to make a lot of money trading very little. But that's not always possible because, again, we want very high probabilities. Oh, you're very welcome. And, when I go back over to my strategy, like I said, for the SPX, you see right here, all the positions for last month, November of last month, BPS, that's bear put spread, bull put spread. That's a bull put spread, iron condor, bear call spread. Okay, so the first one, bull put spread. What is that? Well, it doesn't really matter too much, but it is selling a put. Well, in the name bull put spread, it says bullish, so obviously that's a bullish strategy. The other one, bear call spread, well, the name bear makes you think, okay, we're expecting prices to go down, so that's probably selling calls. Because it says bear call spread. We're bearish using calls, therefore I know I'm selling the calls. The other one, iron condor, is a little tricky, but we'll talk about that in a moment. But one of the main things that happens when it comes to generating income, okay, there's a kind of, I guess it's a common denominator for many of the positions. We want high probability. And unfortunately, we may not have huge wins, but we want consistent wins. And if you take a look at my profit or loss right here, you'll notice, and actually even in my screen or my yearly list, the size of my losses are always bigger than my wins. You'll notice I have relatively small wins here, don't I? $60, $50, 35, 45, 35, 35, 50, 35, and so on. And even in the yearly tracking, do I still have that up? Yes, I do. My average win for the year is only $51. My average loss is $113. So I'm having much smaller wins, but the reason why I'm doing that is I have very consistent wins. My win ratio is much higher on my options trading than it is on any other trading style that I do. Forex, futures, stock, doesn't matter. And the reason why is I look for high probability. So if we want high probability, you could buy a call, but the only way you're going to make money if you buy a call is if price moves in your favor. In this case, it's got to move up. It has to move far enough and fast enough. Okay, so you only have one way of making money if you simply buy a call. However, if you turn around and sell that call, I make money, obviously, if prices go down because it's equal and opposite. But here's the kicker. I can also profit from a sideways move. I'm going to answer that question now, Saba. Saba was asking, are most of the trades credit spreads or versus debit spreads? And they are credits. And this is why. Again, if I'm selling a call, I can make money if prices go down, but I can profit if prices just go sideways, if they don't move anywhere. And I can even profit if they go up just a little bit against me, not much. So looking at this, I have three different ways of profiting, don't I? On the sell side versus only one way on the buy side. So which is a higher probability, 3 or 1? I get 3 chances to make profit or only one way. Obviously, I'm going to take the 3. And the same thing goes on the puts. Buying a put is a bearish strategy. However, if I sell a put, I will profit if prices go up or sideways, or even if prices go down, but just a little bit. So again, I have more probability on the sell side. It's a much better opportunity, higher probability. So going out to a chart, for instance, let's do this. Let's say we want to look at QQQ. I'll go to a daily chart. Oops, gotta clean this up. There we go. And I'll get rid of this for now. All right. So for instance, right now on QQQ, which is the ETF that tracks the NASDAQ, we're obviously in a bullish trend. We're breaking out the new highs. And if I'm looking for where I'd want to buy on a pullback, well, I guess it's going to be right here for my demand, right? What percentage would I say my credit versus debit? Well, in the SPX cash flow, it's 100% credit spread strategies. In my overall trading, I still say it's probably about 80 to 83% where I'm doing credit spreads versus debit spreads. But, it's whatever the market tells me to do. Remember, step 1 is which direction are we going? Well, right here on the Qs, it looks like we're going up. Step 2, are options cheap or expensive? Well, I actually have some tools that can help me out with that. As a matter of fact, if I go over to my Toss Think or Swim right here, and I've got it for different platforms too, but let me just bring this one up. And we'll again go to QQQ. That didn't work. That did. Here I am on QQQ. And I want to know if options are cheap or expensive. So I'm going to go to a daily chart. And insert a study. Oops, there it is, add study. Right there. And what this is now telling me is that options are very cheap. Not duplicate, I wanted to remove it, sorry. Not doing this right, remove, there we go. So this is what I call my implied volatility gauge. Basically what it's doing is measuring volatility versus the volatility that we had in the past. And what it's telling me right now is that options are relatively cheap. You can zoom in a little more to see this better. You can see it's kind of divided up into 4 different ranges, or 5 different areas right here. Options are very cheap. The next one, options are somewhat cheap. You go a little higher, they're fairly priced. And then, of course, as we go up in this range, now options are somewhat overpriced. And then options are expensive. So looking at this, since options are very cheap, we obviously would be buying options right now. So even though the probability might be higher for bullish, right here, bullish green arrow, I've got 2 choices. I can either sell a put or buy a call. So even though I have a higher probability here, this is actually the correct strategy because the implied volatility is very low and we're expecting it to rally from there. Could it go down more? Yeah, but the probability is higher it will go up. So now I know that's my anchor leg. So if I am bullish on the NASDAQ and the Qs for specifically, I'm going to look to buy a call because that's the strategy it tells me to do. So I'd probably buy a call if and when prices pull back to that area of demand. Just like you would normally buy a stock if it price is pulled back to the demand zone. I'm just going to buy a call though, right here, about 390. So if I go to my trade button here and go to QQQ and my trade grid, single option, buying calls are on the left-hand side here, calls. And I need some more strikes because we're a little further away right now, but there is, nope, not enough. Now we have it. The 390 call. Well, I'm not going to buy it right now because we're too far away, but I have to wait for prices to come back and I can buy this. That's it. So I put in my buy order for however many options I want. As a matter of fact, I can even set this up ahead of time saying, listen, I don't want to buy this until we come back and touch that little demand area at 391 and a quarter. So I can set up right here, submit this order to buy at market, buy that call option if QQQ last trade is less than or equal to what was it, 390 point, 391.27. How do you know that that's the demand zone? Because that's the demand zone that I see on my chart based on my rules. You know, when it comes to the trade strategies and everything I do, oops, I wanted to say there, right here in the SPX cash flow, you'll see there's a bunch of educational videos. And in every program that I have, especially when it comes to options, I want to make sure you have the right education to help you. I pretty much, in these programs, I kind of hand feed you the trades. So every day, you'll see right here, there's text messages that go out. So what'll typically happen on a particular day, say this one right here, there's demand that's identified, and I put out the zones that I'm looking at. Then I suggest a educational trade idea. So again, if I zoom in a little more, this was the first one that went out today, or I'm sorry, a couple of days ago, I guess it was. There's a 5-minute demand zone at 4608 to 11, and from 9:35 a.m. that day. And then there was another demand zone at 9:45, and there's a price level. Then there was an iron condor available to sell. It's missing the second part, but it went out with both sides. And then at the end of the day, I give the resolution. But if it needs to be stopped out or adjustments need to happen, basically at 2 p.m. roughly, I send out these SMSs with the trade ideas as well as the zones, and I update in real time. So you could be wherever you want, just log in your mobile phone and place the trades if you choose to. It's real simple. Okay. But basically what I want to show you here as well is going over to the educational videos. If I zoom in, you'll see I've got trading routine and finding zones. So, Timothy was asking, how do we know that's the demand area? Well, fit my criteria here in the documents that accompany those videos. I also happen to have my leg-based zoning technique, which teaches you how to find the zones for yourself. Additionally, on the text that I send out, I put in the zones I'm looking at, so you could literally go back to your own personal charts and recreate them like this. I have all my old zones, so you could look to see, how do I find zones? And then you can practice and do it yourself as well. So for my students, I'm very transparent. I show you all the tools I'm using, and I try to teach you how to do it yourself. So in this one, I could put in this order to buy that option when prices come back to that demand zone. That's kind of neat that I could do that here. Anyway, yeah, if we were bullish on the Qs, we have to wait for prices to come back, and then we could buy the call option when it comes back to our demand zone. And basically what I'm looking for in this case is a big imbalance. You can see prices were moving down and a little sideways, but then we had a big push upwards. And the reason why we had that is there was a large buyer and nobody has sell to them. If there are no sellers, the only way you can attract sellers is raising your price. So somebody was aggressively raising their prices. As you see, prices ran up very quickly. And I can look at different time frames, obviously. Right. And there are screens and other things we can do. So let's start, I was looking at the cues, but let's start at the basics here. Let's say I go to, I don't have the screener on this one. I've got to go to my live account for that. See how long it takes me to get in. Shouldn't be long. And come on. While it's loading, let's see. I was talking about the Greeks, and basically the second leg, I don't know, I did talk about that, right? Yeah, the offset leg is used to manage risk and to change the effect of the Greeks on your trade. That's the wrong one. Where is it? There it is. There's so many things on. So basically what happens is if we were to buy just this call, okay, you'll notice, well, not on this page here, but up here, if I buy the 390 call, and it's not showing much on the Greeks because we only had 3 days. Obviously, I'd be going further out in time because I'd be looking for it to come down to that demand, the balance. And, let's say I want to go for this one, the March option. And again, it was the 390 call that I was looking to buy for that bullish move. So there it is on the 390 call. There we are. Actually, hide that. Now we see that we've got the Greeks that are going to affect the pricing. If we just buy one option, Vega is 0.72, theta is negative 0.1, gamma I'm not going to worry about too much, delta is 0.72. Okay, what if I don't like those Greeks? Well, first of all, let's figure out what the heck do they mean. Okay, well, they're measurements of risk. Delta is how much the premium or the cost of the option will move for every $1 the stock moves, or the ETF in this case. So if the ETF goes up by $1, then let's say you have a delta 0.5. Okay, because the way the deltas are shown, as you see right there, the first column right there, delta, they're in decimals. The highest will be maybe 0.99. Yeah, 0.99. And the lowest it can go is about 1 penny. And this one's only showing 2 cents for the lowest. But let's say you have an option. Oops, where are we here? Current price is 405. So there we are, 405. The delta right now is 0.58. So that means for every $1 that the NASDAQ QQQ goes up, the premium on this option would go up by 0.58 or 58 cents. So that's what the delta is. It's how much prices will move with a $1 move with the underlying. Options are a wasting asset. They're decaying in value as the time goes by. They're like an ice cube. As soon as you take an ice cube out of the freezer, they start to melt, right? And if you have a big chunk of ice, it'll actually melt slower than if you have a small chunk of ice, a sliver. So options with lots of time left will not melt as fast as an option with very little time left. Take a look. So, think about this. D, delta, direction. The theta, T for time. And actually, I'll give you the last one, V, vega, volatility. That's telling you how much you're going to make or lose based on volatility. So those are the 3 Greeks that we really focus on. There are 2 others, but they're not as important, especially newer traders. So, for instance, I did 104 days left until expiration. I was picking the March 28th, 2024. And I said it was the 390 call right here. The theta is only 10 cents. That means every single day that you own that option, that premium will drop by 10 cents per share at the end of the day. By the way, every option in stocks and ETFs are 100 shares. So that means you're going to lose $10 No, sorry, take that back. It's 10 cents, right? Oh, yeah, that's right. Times 100, it'd be $10. You'd lose $10 of that option melting away every day, which, when you think about it, it's not that bad because what's the premium now? 27, right? So again, that's 2,700. So let's see, 0.1 divided by 27, let's say 0.69. That's basically less than 0.3% per day that you're losing. But if you pick the wrong option, it's a mistake a lot of traders make. They try to buy cheap options. Let's say we just go to this one, December 19th. I can make it worse too, but right here, the 390s. Is that right? That doesn't make sense. There's no theta showing. Let's go a little further out. Let's say we only expect to hold this till the end of the month, December. Where's the 390? There it is. And now the 390 is right here. The theta is actually only about 7 or 8 cents. But typically the percentage of that theta will be higher on an option that is expiring faster. So again, we had 0.07 divided by 16.5 or 2. And you can see the percentage is actually a little bit higher. It's 0.4% every day. That's not as big of a deal, obviously, but it becomes usually a bigger portion of your premium if you buy too little time. Okay, so just keep an eye on that. Anyway, Vega is the most important, by the way. That's why I need to make sure I know if options are cheap or expensive, because if you guess wrong, that volatility change can impact your options much more than anything else. So it's really important to know whether options are cheap or expensive, which is why I always check that gauge that I have. And there's other ways of checking this as well. But, think about it. Let me go ahead and look at, trying to see if I can compare. Don't really have very expensive options. Maybe here. Yeah, I'll try that. Okay, so this was what day? March 10th, right? See if I can find an example of this or not. I'm just trying to drive home the point that if you do wrong on the volatility, it can really hurt you in the trades. So yeah, that's March 10th of this year. And the Qs were trading right about 290. As a matter of fact, closing that day, 288.55. So yeah, pretty close to we'll call it 289 for the close, right? All right, so let's go to analyze and what's called think back. It's kind of cool. I can go back and check out to see how much options were on a particular day. It doesn't freeze on me here. This is going to be recorded in the YouTube channel of Wealth Builders HQ. So if you go to YouTube and check out the Wealth Builders HQ, you'll find it. It'll be reposted there. Anyway, so this was March 10th of this year. Oops, wrong one. Oh, you're very welcome. No problem, Philip. And March 10th. There we go. So on those options, out of the way. There we go. This is on Thinkorswim that I'm using right now. There's a lot of different platforms, but this is kind of neat that it's got this tool. So let's say we are looking on March 10th. Again, we were about 289, and we're going to look to, let's say, buy, because let's see. Whoops, I didn't do that right. Yeah, I got a lot of stuff open. Going back to my chart, or actually bring in the chart here as well, but just going to the chart real quick. Again, we're right about 289. Okay. Oh, there we go. There's the link. Thank you, Lee. So let's say we expect the prices to go up, but again, options are very expensive. Okay. Remember, if options are expensive, we should be selling them, not buying them. But what happens if we bought the option instead? So if I go to my analyze and I buy, let's say we buy an option that's expiring August of that year, and I'm going to look for, again, the 289 if I can find it on the call side. So let me trade it. There it is, 289 call. That's the buy. Okay. However, because the options were expensive, really what I should have been doing is selling an option. And going back to my grid, if I want to sell an option, but I'm bullish, you can see the only green arrow is selling a put. So I could sell a put at 289. All right, so let's do that. We go to 289 and we sell the put. And actually, wait a minute, I'm not going to sell the same series, because that's not how you do it. Instead, I'm going to go to a different expiration. And let's see, how long does this rise? Let's do it that way. Let's say we hold it till the end of June. Okay. Yeah, let's do these June 30th. There we go. And again, 289 put. I'm going to sell that instead. Let's see which would have done better. 289 put, sell. All right. So there's our two options. One is buying a call, and then the other is selling a put. Buying the call in high volatility should not work out as well as selling the put. So here we go, moving along in time. It's not giving me any P&L. The numbers are changing a little bit. Let's move it along a little bit here. It's really weird. It's not giving me P&L. I don't know why. Might be an error in the program. Doesn't matter. So we go to the end of March. Oh well. I wanted to show you it, and it's just not adjusting. So maybe I need to do it with something else. I'm not going to waste time on it right now. But typically, if you buy options when volatility is like this, when it drops, you'll end up losing even if prices go in your favor. It's basically what I wanted to show you, but I can't. Let's see, this would have been the 14th from the 10th. Oops, wrong one. I hate when that doesn't work out. But like I said, I was going to try to show you just over the few days. Can't get the data because it no longer exists. No, back testing should show you on the back. I don't know. Oh, well, doesn't matter. Anyway, what I wanted to go to next is basically the way we can offset some of the risk. Remember, we are bullish and we want to profit with the move up. But one of the things that might hurt us could be either delta, theta, or vega. So what we can do is put in an offset leg that offsets that risk that we don't like. And that's how we can generate income without having extra risk by using multi-leg options. People don't realize that. Using multi-leg options, yeah, in order to reduce your risk, you will lower some of your profit, but it's worth it to have that extra insurance and consistently make profits. No, the XLT IV gauge is not built in. It was created a while back by an instructor at a different company that I used to work with, but let me see here, studies. Where's it? I remember. I know I could share it. I got wrong spot. There we go. Share. There you go. If you want it. Is that it? No, that wasn't it. What happened here? Oh, I need to do this. Now we go. There you go. There's a link for it if you want it. Free. I don't mind. So if you use Thinkorswim, you can download that now and import it. Exactly. Jennifer saying, I agree. Reducing risk and still making money is the way to go. Absolutely. I mean, that's the key thing. We want consistency. I showed you the stats. I'm not making tons of money, but consistently profiting is the key thing. Looking at the trades from last month on the SPX, yep, I just passed it. That's all I do. Small wins, but consistent wins. I only had one loss last month. It's crazy. You know, the wins weren't huge. The average win was only $42, but you keep doing that over and over again. By the way, there was only one contract. And by doing this, by the way, you only need, well, I'll show you. The margin to create one spread is right here, $440, 450, 455, 465. So if I showed you the stats over here based on a $2,000 account, and you don't even need that much. In reality, you only need about $1,000 to do that strategy. And the reason why I said two is that way you have a cushion in case you have some losses. But last month, if you had only $1,000 in your account, that was a 71% return for the month. And it's consistent. That's the thing. Again, going to the annual stats right here, these were based on $2,000, but what do we have here? I-16 divided by 2,000. Let me change it to 1,000. So far for this year, if you only had $1,000, you just did one spread for each day, you would have made almost 954% return. Isn't that crazy? And that's just not looking at big wins. It's looking at consistent wins, selling options. That's looking for high probability. We do that by using multiple options. Again, the multi-leg opportunities and understanding how to minimize the risk. And if you could do that by following those 3 steps, where did I have it here? Oh, I forgot where I put it's on this one. Yeah, lots of people have small accounts. And even if you have a large account, you know what you can do? Multi-leg or multi-options. Instead of just doing one contract, you do 5 or 10. That's it. You just want consistency. And absolutely, Sab is saying consistent win style trades makes trading less emotional. We want to be less emotional. If we have something that consistently wins, even if it's small wins, we're definitely going to be less emotional and more logical when it comes to our trading. We just follow a plan. The more that you follow a plan, the less emotional you'll typically be and the better your trading usually is. But yes, it works for small accounts as well as it does for big accounts. Like I said, the only difference between those two is somebody with a bigger account might be able to do 10, 15, 20 contracts. I have one student that does anywhere from 30 to 50 contracts each day. So it works for everyone. But the beautiful part of this is you can start off small with a small account and then work your way up when you feel more confident and when you have more experience as well as capital. So yeah, when we're looking at these options, let's just past it. Right here, we want to neutralize Greeks. So basically, everything's equal and opposite, as I said. Okay. The program that does the live text for me is it's called the SPX Cash Flow Secrets. So yeah, basically what I do, and here's the program. I passed it again. Right here on the SPX Cash Flow Secrets, there's self-paced education to get you started where you can learn about vertical credit spreads, doing different iron condors, how I find trends, all the zoning. And additionally, right there's the strategy, SPX Cash Flow Secrets, and there's documentation that backs up so you can learn on your own. If you run into any problems or you have questions, 2 things. One, I do live Q&A sessions every other month. So we get together and you just ask me, but also in between, right here, you just send me a message and I get back to you. So you're never alone. I kind of handhold you through it. But then what happens is on each day, it used to be once every 3 days, Monday, Wednesday, and Friday. But now every day I send out text messages right around 2:00, as you saw right here. I even labeled the times I did it. So I send out texts and I basically say, hey, this is what we're looking at for a trade idea. And here are the strikes. So as a matter of fact, inside of the SPX, I even have a document understanding texts for SPX. So it shows you what I'm sending you and how to interpret everything as well. Yeah, I definitely don't do it on the FOMC days because those are very, very dangerous. So I typically pass on those days. But for the most part, I can do this every day. And like I said, what we try to do is neutralize the risk. And this is how you do it. Calls, if you buy a call, you have positive delta, negative theta, positive vega. Selling the call does the opposite, negative delta, positive theta, negative vega. And the opposite right here for puts, negative delta, negative theta. Well, it's the same here for calls. Whenever you buy something, you have negative theta and you have positive vega. Remember, delta is tied to that arrow because that's direction, D direction. T for time, V for volatility. So what we can do then is combine some of these. For instance, I have a call and a put here to neutralize risk. You just put them together. What if you bought a call and a put? Well, going back for a moment, if you buy a call and you buy a put, okay, notice delta is positive, delta is negative on the put. That means we might be able to cancel out the delta. And if that delta gets close to zero, that means we now have no directional risk. Prices could go either way or nowhere, and it will not affect our position. We become delta neutral. We will have negative theta, though, which means time is decaying because we have buying a call is negative, buying a put is negative. So we'll lose money on time, but we will gain money if volatility goes up. Okay. Is there, whether there's a scan for call and puts? Yeah, there's different scans you could do to figure out what kind of position you should put on, depending on what tools you're using. There's a lot of stuff out there. On GameStop, yeah. If you look at GME, GameStop, when everything went nuts. So right here, GME, and on a daily chart, I think we still see it. No, we got to go to weekly, I guess. It's been a while. But if you see, it's kind of hard because you don't know spikes in volatility are coming like that. That's going way back here. You see that big spike where we went up. But one of the things you do know about might be earnings, right? They're scheduled in advance. We know when earnings are coming out on different stocks, don't we? So if you know volatility is going to be going up, for instance, right now on Apple, right? Price is very high. So could it go higher? Yeah. Could it go lower? Yeah. But what else is also low right now? Volatility. When does volatility usually rise? It rises as we approach earnings. Look at that. Again, it rises before earnings. Rises before earnings. So if we expect that the earnings are going to cause volatility to go up, if we were to do this, buy a call, buy a put, remember now we have negative and positive delta cancel each other out. So we have very little delta. So it doesn't matter which direction prices go. Vega gets increased. That means if volatility goes up, we make more money. And theta is working a little bit against us, but if we choose the right options, we can lower that as well. This is basically buying a call, buying a put. It's called a straddle. You don't know which way the market's going to go, so you buy them both. And if you do it at the right time, it can work out very, very well. For instance, we had earnings releases here. What day was that? Oh, it was on the evening of this day. Oops, that's not what I wanted. This is where volatility is low. Oh, why is that drawing? There we go. And let's see. They couldn't buy out the shares due to not having enough shares to exit trade to utilize options market. I don't know exactly what happened with all that. There's a lot of manipulation, a lot of things that happen. So I don't want to go too much into it because I don't really know. But anyway, is that a date on this or no? Let's try to see. Oh, now you got to jump into the website. I'm not going to do that. Anyway, earnings were released on August 3rd, 2023. If you had put on that trade June 11th, okay, and on June 11th, we were trading right about 197, right? Is that what it was back then? Oh, no, I'm sorry, I'm looking at the wrong area. We were trading about 181. Okay, so again, let me see if this will work. Go back to think back. Apple. Straddle. There we go. And I'm going to delete these two. And we're going to have to wrap up pretty soon here anyway. But on not the 10th, what did I say it was for the day of entry? June 9th. Analyze. Oops, think back. June 9th. Why is it told don't buy or sell options expiring on or before earnings? Because people do it at the wrong time. If you do it the right time, there's no problem. If you do it the wrong time, this is what kills people. Most people think, oh, I'm going to do this right before the earnings come out. Well, right here's your problem. If you're buying options after volatility has risen, you're paying too much. They're expensive. And where are they going to go once the earnings come out? It drops. This one wasn't a very dramatic drop, so it may not be the best example. Really, what you want to look for is a big change in volatility before earnings. So, and this one might not be too bad, where if you got in back here, then got out, again, you see the volatility drops after earnings. So I'm just trying to show you, this is probably not the best example today, but it's what I got. So right here, if you do this ahead of time, most people make the mistake of doing it right before the earnings. Okay. We want to do it when volatility is very low. So again, on June 9th, getting out August 3rd. So that's almost a month, right? So June 9th, there we go. We look at the options and know we're buying options. That's the other thing. We got to make sure we buy enough time. So perhaps I get in on October options. And at the time, we're at 180. So we're going to buy the 180 straddle. Now it's about buying the right options at the right time. And I'll show you what happens if you do the wrong time. As a matter of fact, let's see. What if I buy too little time? Instead of the October options, I'm only going to hold this until August. So what if I just did the August options? Again, the 180. Oh, did I do 190? It's supposed to be 180. Hit the wrong one. So let me go back and October 180. There we are. So comparing the two different options, the straddles basically, and let's see how it work. It's working so far. And you can see it's kind of weird where one day, this one is showing the August options are making more than the October options. And by the way, before I go too far, when you get into this trade, I don't want to imply volatility, I wanted the Greeks. Right there, the 180 spread, the delta is 0.16 at the time on June 9th. So it's not the best. I want it closer to zero, but it does have very little direction risk. Theta is also 10 cents, and that's not bad, but take a look at the theta, the Vega. The Vega is the biggest mover. So if volatility rises because we bought when it's very low, you'll make a heck of a lot more money. Now, if we go to that October option, which is the one that I was supposed to pick, 180, there we go. Now you see we've got a lot more Vega, very little time decay. We were at 10 cents. Now we're only at 7 cents. So we lose less when time decay happens because we bought more time. Anyway, let me get this all the way to just before the earnings and show you what's happening. There, I'm on June 11th or July 11th now, and still not doing great. There we go, moving and making money end of July. $8.1. And actually, this one worked out pretty well because it was good price movement as well as the directional movement. So you got $351 profit, $282 profit. And then the earnings release. Look at that. You got to make sure you get out at the right time too, because if you actually waited for the earnings, everything dropped. And why do we lose money? Because if you hold on too long, well, first of all, this is where we got in. Prices came right back to where we got in. But the big problem is also the volatility drop and the change of money. Okay. So yeah, basically, there's a lot of little steps. Let's see the picture like this one right here. Is that the one you want to see? So yeah, you can take a picture of that. The gauge is actually, the IV gauge is the 52-week high and low of historic volatility versus the 30-day average implied volatility. That's what it is. And it should be explained in the information when you look at it. So yeah, it's kind of neat that there are definitely opportunities to generate income. I showed you one where it could take several weeks to make money. because what you're doing basically is trying to profit over the volatility increasing or even prices moving over a period of time. So right here, again, if I go back where it was actually profitable, there you go, a few days before the earnings release, there you go. Could have made some decent profit. Or like I do, you can also take this into an intraday opportunity where I get in and literally hold on for less than 2 hours to make profit every day. So the choice is yours. But the key thing is you got to learn about the options first. Try to keep it as simple as possible. As I said, you can learn through me in the SPX program, or there's also other opportunities that Rob has and other instructors we have here at Wealth Builders HQ. So yes, have a happy holidays for everyone. Yes, basically real quick, if there's any questions, I'm going to wrap up now, but you can always let me know if there's any questions. That IV gauge that I shared with you, what it's doing is it's taking the 52-week high and low of historical volatility. Then it's dividing it into the 5 ranges. So the gray lines, okay, the dark line at the top is historic volatility, 52-week high. The low, or the bottom, is historic volatility, 52-week low. And basically that range between the high and the low is divided into fifths. So that's what gives you the different sections there. The red line is current 30-day implied volatility. That's all you're doing is you're comparing the current implied volatility to the historical volatility, 52-week high and low. And that's it. And yeah, the IB gauge, I shared it a little while ago. I'll share it again here. If you're on Thinkorswim, there it is. So like I said, if you want more of this, you want to learn how to do all those trades I was doing, generating income on a regular basis, join me. If you join me in the e-mini, not that one, this is the SPX cash flow. Basically, there's 2 different types of subscriptions. We put out the link just a little while ago, and I'm sure Lee will put it up there again for you. But if you click on that SPX cash flow secrets link, there's 2 types of subscriptions you can do, either monthly or quarterly. And here's the cool thing. If you do quarterly, there's no risk. And here's why. You click on this right there, that link, you can do $2.95 a month or $6.95 a quarter. There's a 2-week free trial. We don't even charge your credit card for the first 2 weeks. So try it out. You actually get access to all the videos, all the text right away to try it out. So this is both. This subscription is both the self-paced education. So basically what you get for that subscription is all the access to self-paced education right here. You get the Q&A sessions that we do. We just did one last night, as a matter of fact, or no, 2 nights ago, Wednesday, I think it was. So we had another Q&A session. We'll do another one coming up in, I think, January, February, I can't remember. And then you obviously get access to me with all the information. You can message me, email me, whatever. Plus, you get the text messages every single weekday. So it's all that included. And again, if you just want to try it out for 2 weeks, try it. You got nothing to worry about there. So I got to run. I got a bunch of things I got to take care of. I want to wish everybody happy holidays. There are recordings for the old Q&A sessions as well. Yes, and all the educational videos are recorded. These are all the past trading results up to November as well. So you can see what's been going on as well as the zones. So yeah, everything there for you. So absolutely. I want to thank everybody for being here, and hopefully I'll see you again soon. Trade safe, trade well, everyone. Take care. And yeah, happy holidays.